Why do I need to see those blue eyes looking at me that way again?
Okay, let's continue on here in video 2 with starting at transaction 4, talk through some more transactions and see how different things affect both the income statement and the balance sheet. So here we are selling $1,000 worth of stuff on credit. The inventory is carried at a cost of $800. So the only difference here is that we're not selling on cash right away, but we're creating an accounts receivable, so we'll see that in the balance sheet. Let's first look at the income statement, and basically this is exactly the same as it was on the previous transaction. Our revenue is $1,000. Our cost of goods sold has increased by $800, so we have pre-tax income of $200. If we tax that at 25%, our taxes are $50, and the income that's remaining is $150. On the balance sheet side of things, instead of cash, we just are increasing our accounts receivable. So it'll turn into cash someday, but for now we just have a receivable. Everything else is the same as it was on transaction 3. Our inventory has gone down by $800, our taxes payable has increased by $50, and our retained earnings has increased by $150. So if you look at the assets and liabilities and equity side of things, the assets have increased by $1,000 with the accounts receivable, and then inventory has gone down by $800, so we have $200 increase in the assets and then a $200 increase in liabilities plus owner's equity. That's the taxes payable and the retained earnings. All right, let's move on to the next transaction and look at a very simple transaction here of depreciating an asset by $10,000. So in the income statement side of things, we've got depreciation expense going up by $10,000. That means our pre-tax income, everything else being equal, would go down by $10,000. Our taxes would also decrease, this time by $2,500, and our net income would decrease by $7,500. On the balance sheet side of things, our net fixed assets would be $10,000 lower. There's no cash changing hands, no cash effects, but the book value of our assets has gone down. If we had these things split up into gross assets and accumulated depreciation, the accumulated depreciation would have increased by $10,000, and so our net fixed assets would have decreased by $10,000. Again, the taxes payable would have decreased by $2,500, and the retained earnings are down by $7,500. If we look at the assets and liabilities, our assets are down by $10,000, and so our liabilities and equity must be down by $10,000, and that's what's happening. All right, let's move on to transaction 6. This is a very simple transaction. We're borrowing $100,000 for 6 months. In this particular transaction, there are no income statement implications. Nothing is happening to the revenue or expense side of things. The only thing that's happening is our cash has increased by $100,000 and our notes payable has increased by $100,000. So we've got an asset that's gone up and a liability that's gone up in the same amount. And so everything is hunky-dory. Transaction 7 is similar. This time, instead of raising liabilities or raising debt, we're raising equity. So assume that we're selling $1 million of additional common stock. Maybe it's a follow-on offering or something like that. In this case, again, no income statement implications. And on the balance sheet side of things, our cash has gone up by $1 million, so an asset has increased. And in this case, our equity has increased by $1 million. So the par value of the stock plus the additional paid-in capital on that stock will equal the $1 million that we raised. And then finally, we're going to sell something for future delivery here. So we're going to create a new liability account, deferred revenue, and we'll see how this affects things. So we are selling something for future delivery, so we're not giving them the goods today. It's a $10,000 sale, $8,000 in inventory. That's what we're carrying the inventory on our balance sheet at. And this is going to be paid today in cash. So an important rule here that we need to think about and remember, firms cannot recognize revenue until the product has been delivered or the service completed. So if we do something like the scenario I outlined above, we're going to use the deferred revenue account as a parking place for this transaction. And then once we deliver the goods, deliver the service, or complete the service, then we would kind of unwind that deferred revenue and then let everything hit the income statement. So let's look and see how that would work. There's no income statement effect initially, but on the balance sheet side of things, our cash is going to increase by $10,000. So that's the asset. And the deferred revenue is a liability account. It will increase by $10,000. So this is at the exchange of cash. Now, once the sale is consummated, when we deliver the goods, we are going to have, as I mentioned, the income statement effects occurring. So revenues will be $10,000 higher. Our cost of goods sold will also increase at that time by $8,000. So we'll have a pre-tax income increasing by $2,000. Because our tax rate is 25%, our taxes will be going up by $500. And the net income will be the residual $1,500 increase there. On the balance sheet side of things, inventory will decrease by $8,000. Our deferred revenue will go away now, so we're going to unwind that liability. It'll be down by $10,000. Taxes payable will be up $500, and the retained earnings will be up by $500. By $1,500. So let's look and see what the asset side of things and the liability side of things is. So the asset side of things, the inventory, is down by $8,000. So that means the liabilities plus the owner's equity will have to also go down by $8,000. Now in this case, the deferred revenue is a liability. It went down by $10,000. Taxes payable went up by $500, so the net change in liabilities is down $9,500. But when we add in the owner's equity effect, or that change in retained earnings, we now have a net change in liabilities and equity of down $8,000, and so everything again matches. So everything is good there, and those 8 transactions are kind of a good overview of the different types of things. Very simple, stylized transactions, but it shows you that link between the income and the balance sheet. Okay, I'm going to go ahead and start in on part 2 of the material here, talking about deferred taxes. We still have several minutes left in this video before we reach that 10-minute mark or so. So let's just jump in here and talk about deferred taxes. This account is really coming from the difference between the taxes that we show on our financial statements, which are prepared according to GAAP accounting, and the taxes we actually pay to the government based on the tax code. So this is a long-term liability, and we're going to talk about kind of how it comes about and how it might go away over time. So let's look at just a simple example here. Think through one. In GAAP accounting, you would depreciate your assets on a straight line basis. So if you've got a 5-year useful life, you're going to buy something and depreciate it, which means recognize the expense of this thing you bought over that 5-year period of time. And you're going to do it in equal increments over those 5 years. So straight line is very straightforward. But for tax purposes, you may be depreciating that asset on an accelerated basis. This means that you'll have a higher depreciation expense, and it also means that you'll have less in taxes than you might otherwise owe. So in terms of what you're showing to shareholders and what you show to the government, you're going to have a difference in the taxes paid. So that's going to create or give rise to this deferred taxes. So if we continue here, for GAAP purposes, you're recording taxes as if you told the government the same thing that you told shareholders. So that is, our depreciation expense was lower, our taxes were higher, but the actual taxes are different, and in this case lower, the one I've been talking about. So when you pay less in taxes than it seems you should have, you're going to end up with extra cash. You'll have more cash than you should. And so to offset that extra cash, you need a liability account, and in this case, we're going to call that deferred taxes. So let's say you show a $5 million tax expense on your books, but you really only have to pay $4 million to the government. You've now got $1 million more in cash than you should, so you will increase the deferred taxes by $1 million to offset that difference. Now, I'm going to look in more depth at this example, but I don't want to rush it, so I'm going to go ahead and stop here. And in the third and final video for accruals and deferred taxes, we will look at this example, walk through it, and then close off the videos. We'll pick up with some more videos looking at the statement of cash flows here later in the module. So until then, I'll see you.
And I've got $2 in the jukebox, $5 in a bottle, 10 more just in case that don't do the trick. And I'll be dead broke tomorrow morning with heartaches by the dozen, and a lady on my mind that's driving me crazy. Why do I need to see those blue eyes looking at me that way again? after the way she did me. It's a sin. How could she just walk out and leave me after all these nights in her arms? Look where I am. And I've got $2 in the jukebox, $5 in a bottle, 10 more just in